Our next conversation is on regulating for growth. Simply put, that means knowing how to throw a great party, but also knowing when to stop the music. To discuss that, please welcome to the stage Ananth Narayan, whole-time member at the Securities and Exchange Board of India, SEBI.
Take that one.
Good evening, and Ananth, thank you very much for being here.
Thanks for having me.
You've heard the context, so I'll jump off into the deep end. What can be done now, after years of incremental improvement, to deepen India's corporate bond market? What would you say are SEBI's top priorities?
Right. Few areas that we are working on pretty hard. First is on the corporate bond market itself. We've finally got the limited purpose clearing corporation up and running. We're seeing about 1,000 crores of repo transactions happening every day. That's still small. We still have ways to go. But it's showing good progress. And I think one of the long-standing requirements of the market has always been that there should be liquidity available for traders and for market makers to be able to access. We think LPCC has a good future, and a few more things, including RBI's recognition of LPCC as a qualified clearing corporation, will help deepen this market even further. So that's a good step that's already in motion. What will bring more foreign investors to this market, given that there's still a very, very small element of it? On that, I guess the fact that you had the index inclusion in the sovereign bond space should spin off into more. Okay. But I think the reality is the domestic market has to deepen first before we actually think about using the foreign route. The second thing that, besides LPCC, we have the backstop facility in place now, which was a requirement from the earlier crisis. That's in place now, and that's up and running. We're also doing things like, for instance, we're the first regulator really which has allowed our regulated entities to sell protection via CDSs. First in AIFs, the alternate investment funds, and now in mutual funds as well. So it's a whole bunch of things that we're trying to do to help build the ecosystem. Anything new? Finally, we do want to make headlines tonight. I'm going to keep this really boring. I'm sorry. But on the alternate investment space as well, on the AIF space, about 1/4 of the investments that we are seeing coming through the AIF space is towards credit. Again, I think there's a lot that we can do there to try and see if we can foster more of the private credit space. It's not directly into the corporate bond market, but all of it counts. Overall, I think across corporate bonds, InvITs, REITs, munis, these remain clearly focus areas for us. Yeah, actually, I should have said this in the introduction. It's very interesting if we are in an era of this big shift away from bank credit to non-bank credit, and then, areas like AIFs, even PMS investments, the newer products that you introduced, I think the new investment strategies products, the corporate bond market, of course, effectively you will become a far more important regulator at SEBI, over time, when it comes to credit, right? Yeah. So I think the way we have to see this is, look, we are channeling a whole bunch of savings into investments via the capital markets. At the moment, the flavor appears to be equity markets. So the last fiscal year, FY24, we had about 3.6 trillion rupees, 3.6 lakh crores coming in via individuals, mutual funds, domestic institutional investors, even foreign portfolio investors into the equity markets. I think that's been the trend so far. But as things stabilize, I think you'll see people starting to do more of asset allocation, more of diversification, and I think it's inevitable that debt markets will pick up as well in terms of investor interest. So our effort is let's try and keep the foundation and the guardrails strong in both equity markets as well as in debt markets and everything that goes along with it, including hybrids. And then the investors will sort of come there and settle down as to where they go. Sure. But I'll ask you for specifics, right? Like we've spent the evening discussing, some of the risks in the AIF space, the private credit space. The numbers are
now becoming significant, about 12 trillion rupees in the AIF space, 10 trillion in the PMS space. Where do you see risks? You've acted against evergreening of loans alongside RBI. You've acted on concerns around valuation. You've acted on concerns of preferred rights to some investors in AIFs. Where are the new risks emerging?
Look, it's an ongoing journey, and you're right, we've seen fantastic progress in AIF specifically over the last 5 years. By the way, the September data suggests we are now 12.5 trillion rupees worth of commitments and about 4.5 trillion rupees worth of investments.
Right.
And it's grown, both have grown at roughly a compounded annual growth rate of about 30% over the last 5 years. So it's been very, very steady growth. I think from a regulatory perspective, and you've heard me say this before, Menaka, we're looking at this in two ways. One is we are seeing instances where AIFs have been in the past, particularly in the past, been misused as structures to circumvent existing regulations. You mentioned, evergreening. There have been other issues as well around FEMA, about IBC, and so on and so forth. At the same time, we're very clear that while we want to stop that, we can't come in the way of good business. Our regulatory response has to be very calibrated and very focused. Stop the bad things, don't come in the way of good things, and if possible, actually try and encourage good things. So if you see the response we've taken in the last few months, we've actually come out with a bold regulation which says, do not use AIFs as a structure to circumvent. Now that sounds like a very scary regulation, very broad-based regulation, but we've converted that to actual standards which the industry has set on what are the specific do's and don'ts that they have to adhere to ensure that they are not circumventing evergreening regulations or FEMA regulations or IBC regulations. That gives us the space to actually then liberalize a lot more. So if you saw the last board meeting, we've actually allowed tranching of certain amount of units in AIFs, sure, which was an issue that we had because of evergreening, etc. We've allowed parts of that. Previously, we've allowed pledging of investee company equity by AIFs in order to raise funds at the investee company level. All of these are steps to liberalize while at the same time ensuring
that. But that's all backward looking. I'm trying to look ahead and say, where do you see the new risks?
Look, I think that this journey will continue in terms of
at the moment, do you see spots of weakness in the private credit market, whether it's through alternate investment funds or even through PMS investments? How do you see that evolve?
It's an ongoing journey where all of it, whether it's investor protection, whether it's structural risks, have to be taken into account. In the AIF space, of course, the level of investor protection required can be lower, and that we are cognizant of that. Of course, we still have to manage that bit. What has been dominant over the last the couple of years that I've been in SEBI has been the structural element, the fact that some structures are being used to circumvent existing regulations. And again, our focus has been detection, making sure that there is prevention in place, and that whatever we do in terms of detection and prevention does not stop legitimate business. That's been our effort.
Okay, so through the evening we've discussed the corporate bond market, the private credit market, whether it's through alternate funds or through other routes. We've also discussed foreign investor participation. Right. That is an area that comes directly under you, and it's been an area of lots of activity over the last 2 years, most specifically your effort to get them to disclose their beneficial ownership. How many funds have exited India because of the additional compliance paperwork that has come into what is a very necessary rule? I'm not arguing against it, but how many of them have chosen to say, hey, this is too tedious, we're out?
I think the important number to focus on is, one, at this point in time, we are in a state where we can say that there is no FPI which has more than 50% concentration in a particular corporate group, where either we are not completely comfortable that they are a public retail fund or a sovereign wealth fund and therefore we don't really have any issues, or where we've not got 100% details about every single economic interest holder in that particular entity. So, and by the way, a lot of FPIs actually have disclosed very, very granular details about the economic interest holders in their entity. So that, I think, is a number to focus on. In terms of the specific question that you're asking, Look, again, the number to focus on, if you ask me, is over the last, since April of 2023, when we had these discussions ongoing, we've seen net $27 billion of inflows come into our equity markets through FPIs.
We've also seen outflows, Ananth. I apologize for interrupting you.
I'm talking about net numbers. Now, I can also tell you that I think there's a large understanding about why we have taken the steps that we've taken.
Sure.
And the fact that these steps are an important step to ensure that there is confidence in the markets, and there is faith that, there are checks and balances to ensure that there is no circumvention or breach of any regulations.
Again, I'm not questioning the regulation. I'm just curious to know how many have exited India. And fine, the regulator may say, but these are our rules, and if you can't comply with this, you're free to go. I'm just curious to know what the response has been. That's all.
I think the response has been overwhelmingly positive. As I said, there have been a lot of actual FPIs who have actually disclosed to us. If you want granular details, what we will try and do is maybe come out with a white paper on the entire journey. Because giving numbers in bits and pieces, look, we have disclosures which are made as a matter of course. How much inflows come in, how much net outflows go in. By the way, attributing motives to every inflow and outflow, I can tell you, is not an easy job.
Okay.
You'll have to do a lot of speculation there. So the point is, we know the aggregate numbers, what they look like. If you want a white paper, maybe our research team can look at it. But I think the important thing to note is this has gone off reasonably smoothly, the implementation of the August 2023 circular. You've not heard too much of noise about it. In fact, we've seen net inflows come through, notwithstanding the last few days. It's been very large inflows that have come through. I think the confidence in the Indian market remains pretty large, and we will ensure that it remains that way.
Okay. We've talked about KYC, or Know Your Customer norms, through the afternoon. The governor said, but that's, SEBI's mandate. What have you been able to do to simplify that process, to bring more foreign investors here? What have you identified as things that yet need fixing, which the regulator is on the job for?
A few things that are already in progress. You've seen consultation papers coming out from us. The last one, I think, which came out last week, we have a common application form for foreign portfolio investors to come into the country, which is across RBI, which is across SEBI and across CBDT, because you also need a tax PAN number when you come into the country. It's a common platform. We've come out with a consultative paper which suggests that for certain kinds of FPIs, which are pretty frequent, we can reduce the number of fields in that particular form by up to 45%. Okay. Now, what we're trying to do, Menaka, is actually take a very risk-based approach on what can we do to make life easier. Now, I can talk about a couple of more things that we're looking to do. One is for investors that are only investing in sovereign government bonds as a result of, the index inclusion and so on and so forth. We're going to reduce a lot of requirements from the SEBI side. We're in fact going to rely entirely on what RBI asks for in terms of KYC, and make sure there's not a single piece of information more that's required from a SEBI side. Of course, we'll have checks and balances to ensure that there are no equities that they hold and so on and so forth. The third thing, which I think is very exciting personally for me, the other circular that you were grilling me about, the August 24th circular of last year.
The beneficial ownership.
The beneficial owner one. If you remember, what we did was we spent a lot of time on identifying foreign portfolio investors where we really don't need to insist on granular exposure to the last cent, even if there was concentration norms which were being fulfilled, for instance. For instance, if you're a sovereign wealth fund, if you're a government-owned entity, if you're a public retail fund, if you're an insurance company, regulated insurance company investing your own funds, or a pension fund, or a listed entity in certain exchanges. Now, what we realize is there's a whole host of these entities where there's a lot of comfort and trust, verifiable trust around their existence. Now, what we're trying to do going forward is see that if for these particular set of investors, can we really reduce the requirements, both for registration as well as ongoing compliances? For instance, can we do with just swift confirmations of a lot of paper, which otherwise comes as wet signatures going up and down and creating, bottlenecks. So there are plenty of things that I think can be done on that score.
Okay.
That again will be, we're a consultative regulator. We'll come out with a consultation paper hopefully soon, for these, and by the way, they account for a significant portion of the assets under management that are already in the country. These are truly trusted and verifiable FPI, where I think we can do a lot of work. Again, what I would really like is, especially from your viewers and your subscribers, if there are specific suggestions on what we could do to cut down on paperwork, on red tape, very, very happy to take those on board, particularly for these kind of investors.
All right. I want to do a couple of very quick, non-credit market questions, because if we have the regulator, it can hardly waste that opportunity. In the last board meeting, you all suggested that instantaneous settlement was out of the window. You were only going to do same-day settlement. Why? I mean, have you closed the door on instantaneous settlement?
For now, we've closed the door.
Altogether?
For now, we've closed. No, yeah. For now, I can't speak for my successor or her successor. But the broader objective really is to try and ensure that we de-risk the system and we reduce any level of opaque charges which are there in the ecosystem amongst the intermediaries. So one of the issues that we've found is that there's a fair amount of client investor money that stays with intermediaries, either with brokers or with custodians, through the course of the trading and settlement process. Now, what we are trying to do is to try and keep investor money with the banking system, which is a regulated ecosystem, rather than have them with our intermediaries, which are not really banks. Now, this is the way markets have always operated for many, many years. What we find is that things like using the UPI block mechanism to be able to trade in secondary markets or the optional T+0 mechanism helps in that process of ensuring that there is less float sitting with the intermediary ecosystem, thereby reducing opaque costs and reducing risks as well. Now, this is, one step towards that, as I mentioned, is T+0. It's not really taken off despite the beta version that we've launched. Of course, we've now have the board approval to expand that to 500 securities and do it across a lot more brokers. But one of the issues that we got as a feedback from the ecosystem was, if you're going to say that you're going to eventually move from T+0 into instant settlement over the next few months or even quarters, why would we want to invest in T+0 at all? It's after all a stopgap kind of a mechanism. So, and we also recognize that the actual settlement mechanism in instant settlement is very different from what we have currently. T+1 is effectively being crunched to give us T+0. It's not a fundamental shift in the nature of the trading or settlement. But instant settlement would be dramatically different because every single trade will have to be gross settled. And that's a totally different technology architecture. So both in terms of the investments required for instant settlement and therefore the changes that we would subject the ecosystem to, and in terms of what it does to T+0, if nobody's going to be interested in T+0, optional T+0, because they're waiting for instant settlement, we thought it's not a great idea to talk about instant settlement. So it's completely off the table for now. We're going to focus entirely on this optional T+0 and see how that goes.
Okay. You've just put into effect, in a phased fashion, a set of new restrictions when it comes to trading in the F&O market. I'm just simplifying it for a global audience and not getting into too much detail. Is there more to come in that area? Because to me, it seems like SEBI there is this war on speculators going on at SEBI, whether it's in the cash market where you've now underscored twice the kind of losses that day traders are making. And in the F&O market, you've not just signaled the losses, but you've taken severe actions to curtail their participation in the market.
So for the record, Menaka, first, we like derivative markets. I'm not saying we're not against. I'm saying we like derivative markets. We are definitely not against speculation or trading or market making. We know these are essential for the market in order to have price discovery, in order to have depth in markets, in order to have people have avenues for hedging their risks. So it's absolutely essential. So we have no doubts in our mind that these are essential components of the ecosystem. What we are trying to do is twofold. One is we are focusing very, very sharply on areas where we believe that the speculation level has gone to a situation where there is serious threat to investor protection as well as to systemic stability.
So you're saying the situation at this point actually is a threat to systemic stability? Because in previous commentary, SEBI has not said that.
What we are saying is that the level of activity that we saw on expiry day index options, which was practically a 0 day to expiry trading of index options, very specifically was an area where we didn't see too much of, positive things going towards capital formation. Instead, we saw a lot of risk to investor protection and systemic risks building up as well, because actually the open interest in these kind of contracts was building up right up to 5 minutes before expiry. So what we are doing is a very, very targeted attempt to try and ensure that trading in index options on expiry day is controlled. So out of the 6 steps that we've announced, 4 of them are clearly focused on this. So it's a very focused approach. Now you have to juxtapose this with our new, entry and exit criteria that we've announced for single stop options and futures, which actually expands the pie of number of stocks which are available for F&O. There are plenty of other steps where we are taking to actually increase the depth in the derivative markets in consonance with the depth in the cash markets as well. So it's a very focused approach. We are not against derivative markets. We are not against speculation. We are focusing on areas where we think that the pendulum has swung too much into an area causing both systemic risks as well as risks to investor protection.
But
the second area...
This is the first time I've heard you say systemic risk when it comes to this. So far it was losses, it was a waste of money, if I may say so, because it's not going towards productive, requirements. This is the first time I'm hearing you say systemic risk.
I would encourage you to read our consultation
I've read it several times. You have not said systemic risk.
And the speech I gave earlier. By the way, in both the cases, we've talked about systemic risk. The fact that you have open interest which goes up right up to the expiry time, at a time when we don't monitor individual level risks or individual level OI on real-time basis, is a risk. The second part, you talked about intraday cash trading and numbers that we give out. Look, in fact, the first pillar in our preamble of the SEBI Act is investor protection and investor awareness. So you've got to our job is to make sure investors are aware, right? So when we talk about 93% losses over the last 3 years on F&O trading, or when we talk about 70% losses for intraday trading, these are a part of our investor awareness and education programs.
Sure.
That doesn't mean everything is going to translate into regulatory action as well. If you recollect, our first report came out in January 2023 on the F&O part, right? Now, it's taken us till now to actually talk about taking steps to control a very, very focused and specific part of the F&O markets. So we're very thoughtful about the way we do things. The Hippocratic oath about first do no harm is right there on my wall in my office, right? So we know that as a regulator, we've got to be very, very measured in the way we act, and we are very thoughtful and consultative in the way we act. So
more F&O restrictions coming?
No, the way we're going to do is. As you know, most of the steps that we've announced come into effect from November 20th onwards.
In a phased fashion.
In a phased fashion. A lot of them start to take effect from November 20th, and others January, February, I think there are other dates, April as well. But we will obviously watch how the markets pan out after that. We will see what happens to the volumes. We'll see what happens to the trading ecosystem. And then again, in a consultative fashion, depending on what the landscape looks like, we will have discussions, open discussions. Nothing that we do is behind closed doors. It's all an open discussion.
But you're saying you are considering.
We always look at data. We always look at the context, and we will always consider actions in a consultative fashion.
Okay. One of the things you pointed out, two last questions. One of the things you pointed out in a recent speech was the gap in supply and demand of paper in the equity market. We've seen a flood of IPOs. You've seen that gap narrow. I mean, given the response to, I don't want to name an IPO because then you won't answer my question, but given the response to one large recent IPO, do you feel that gap is narrowing? And that's a healthy thing.
So you're right. I have spoken about this gap between supply and demand. Again, look, it's part of our effort to ensure that people are aware of the risks in the market. This is an ecosystem where we've got to get financial inclusion, where we get savers to become investors and contribute towards, risk capital, so that issuers can come raise risk capital and create businesses, and that cycle becomes a virtuous cycle. That's absolutely our goal. At the same time, we need people to come in completely aware of the risks, so that this is a sustained cycle rather than that one that goes in spurts. Now, a couple of things. Last year, FY24, was actually a dream year in many ways for Indian capital markets, Indian equity markets. So benchmark indices, grew at 28% during that fiscal year, and the actual realized volatility of that index was 10%. So this is the best of both worlds: low volatility, very high returns. Now the problem with things like that, and there is a downside to it, is it breeds complacency.
Yeah.
So the last year was a year, I mentioned to you that 3.6 trillion rupees was the actual inflow that came into the markets from individuals, domestic institutions, as well as foreign institutions. The actual supply was just 1.95 trillion rupees. So you had a mismatch of about 1.65 trillion rupees. Now, this year, by the way, if you look at the first few months until, I think, August or maybe even September, the actual inflows into domestic mutual funds from retail investors into risk-oriented fund schemes already exceeds the number which came in the whole of last year, right? Now, of course, supply has gone up, but demand has been pretty high as well. I think these things equalize over time. These things, you can never have a perfect situation where supply of fresh paper is exactly equal to the demand that's coming in from all investors. In a sense, at a personal level, and this is not a SEBI view, at a personal level, I'm not really upset about the current volatility, if you can call it volatility, because in a way, it reinforces the fact that this is capital markets do come with risks. It's important that particularly retail investors be aware and be acutely aware of the fact that this is not a one-way street where you only have good news and not really the volatility as well. Particularly since a big chunk of the people entering our capital markets now are young people who've really not seen cycles. Yeah. So it's not bad to have volatility. In a way, for a sustained growth in capital markets, a spot of volatility is not a bad thing at all.
Okay, final question, because really it's going to be otherwise a long, I have many, but it'll be a long evening for everyone. It's been, 2 years since you joined SEBI and you moved over from that side of the room to this side of the room. And it's been a tumultuous 2 years at SEBI. What's the shift been like?
It's been brilliant, Menaka. I have only the deepest sense of gratitude to Providence for giving me the opportunity. Couple of things, First is, I've been an industry person and then an academic for several years of my life. I've always felt through my career that, all stakeholders sometimes tend to talk past each other than talk to each other. So, industry, financial services, investors, regulators, policymakers, academics, sometimes you're not listening to each other. And wearing these different shoes, in a small way, I'm trying to connect the dots and make sure that we, understand each other's perspectives better, because I think that's important to see the capital market ecosystem grow. The second part, really, which has been a very positive revelation for me, it's been a remarkable experience within SEBI. The people there are fantastic, an extremely professional, competent, knowledgeable set of people with tremendous amount of institutional knowledge and history. It's a very professional organization, and both the board as well as the folks in SEBI have actually allowed me to deliver my job to the best of my ability and with a clean conscience. Now, whether it's on policy matters, whether it's on enforcement, whether it's on me as a quasi-judicial authority, or administrative matters, what more can I ask for than that I can do my job professionally in a professional organization with a clean conscience?
No Hindenburg report. That's what more you could have asked for. Ananth, thank you so much for joining us.
Yeah.
No, finish, please do.
No, I'm waiting to finish my role as a regulator, and then, I'll probably write a few things. But I can tell you this. What I'm saying now will be something which I'll say even after I move out of SEBI, when my stint is over. I think there's a lot of reason to trust the ecosystem and trust SEBI. It's a very professional organization where we work with a lot of checks and balances. And as I said, as an outsider coming in, I've had the full support to do my job professionally and with a clean conscience.
You won't give the chairperson's job a shot?
We'll talk about that later. That's not on my radar at all at this point in time. As the governor said, I'm more worried about what's the files on my table right now than the future.
All right. Thank you, Ananth, so much for answering all the questions with candor. And I must also thank the audience. So first, thank you.